Welcome to TickerWatch News for Apple, Week 4 of 2026. This episode breaks down the key news, market movements, and analyst updates for the Cupertino giant as it heads into a critical earnings week. This podcast covers the data and developments reported through Sunday, January 25, 2026. It has been a choppy start to the year for Apple shareholders. While the broader market has seen some upward movement, with the S&P 500 posting fractional gains, Apple has lagged significantly. Over the past month, shares have dropped approximately 9%. Year-to-date, the stock is down roughly 8.7%. As of the close of this trading week, the stock sits around the $248 level, which is a stark contrast to its 52-week high of over $288 reached back in December. This downward pressure has pushed technical indicators into extreme territory. The Relative Strength Index, or RSI, dipped to around 18 earlier in the week. For context, that is the lowest reading for Apple since September 2008, signaling that the stock is deeply oversold. Despite the heavy selling, there was a brief respite on January 21st, where shares snapped a 4-day losing streak following reports regarding new AI product developments. However, the overall trend for the week remained under pressure as investors weighed high valuations against potential future growth. There were several major stories driving the narrative for Apple this week, ranging from future product rumors to significant supply chain shifts. First up, reports surfaced regarding a potential new form factor in Apple's lineup. Sources indicate the company is developing a wearable AI pin intended to rival previous attempts by companies like Humane. This device, rumored to be about the size of an AirTag, would feature multiple cameras, microphones, and a speaker, with a potential launch date as early as 2027. While some view this as a way for Apple to deepen its ecosystem, others remain skeptical given the poor market performance of similar devices launched by competitors in 2024. In significant investment news, filings revealed that billionaire Peter Thiel's fund, Thiel Macro, sold off 76% of its position in Tesla and redeployed capital into Apple. While Apple remains a smaller allocation in the fund compared to Tesla, market observers interpret this move as a shift towards blue-chip safety amidst a murky macroeconomic picture. Thiel's pivot suggests a preference for Apple's stability over the higher volatility currently associated with other tech high flyers. On the supply chain front, a major changing of the guard occurred. NVIDIA has officially dethroned Apple as the largest customer for Taiwan Semiconductor Manufacturing Company, or TSMC. NVIDIA now accounts for 13% of TSMC's revenue, a spot Apple held through the 2010s. However, Apple remains a critical partner, reportedly securing about half of TSMC's 2-nanometer production capacity for its upcoming A20 and A20 Pro chips. Finally, looking at international markets, Apple recorded its best year ever in India. In 2025, the company shipped approximately 14 million units in the country, capturing a record 9% market share. This growth occurred despite the overall Indian smartphone market remaining largely flat. The data shows a clear trend towards premiumization, with the segment of phones priced above $327 growing 15% year-over-year. Apple also expanded its retail footprint in the region and introduced lower-priced subscription bundles for creative software to drive services revenue. Wall Street analysts were active this week, with many viewing the recent dip as a buying opportunity rather than a reason to panic. Goldman Sachs reiterated a buy rating with a price target of $320. Their analysts argue that the year-to-date drop is a chance to load up on shares before the next iPhone cycle. Goldman forecasts that iPhone revenue will grow 9% in both fiscal 2026 and 2027. They point to several future catalysts, including a rumored iPhone Fold in late 2026, a shift to a biannual launch cycle, and the release of an iPhone Air 2 in spring 2027. UBS maintained a neutral rating with a $280 price target. Their supply chain checks indicated a modest pull forward in production during the December quarter, driven partly by rising memory costs. However, they raised their iPhone unit sales estimates to between 84.5 and 85 million units for the quarter, noting strong early demand for the iPhone 17 series. Wedbush remains one of the most bullish voices, maintaining an outperform rating and a street-high target of $350. They characterize 2026 as a potentially monumental year for Apple, driven by its AI strategic roadmap. Overall, analyst sentiment leans positive. Of 42 analysts covering the stock, 21 rated a strong buy and 16 rated a hold. The consensus price target sits roughly at $289, implying an upside of about 16 to 17% from current levels. From a technical perspective, the standout metric is the oversold condition mentioned earlier. With the RSI dropping below 20, the stock is statistically stretched to the downside. Historically, such extreme readings have sometimes preceded a rebound, especially when the underlying fundamentals remain intact. The stock is currently trading about 14% below its 52-week high. Fundamentally, valuation remains a key debate. Apple is trading at a price-to-earnings ratio of roughly 30 to 33 times, which is a premium compared to its industry peers. A discounted cash flow model by Simply Watt Street estimates the stock's fair value at around $226. With the stock trading near $248, it is hovering close to or slightly above that calculated fair value. The company receives a D grade for valuation from Zacks, indicating it is trading at a premium. However, the growth narrative is supported by expected earnings per share of $8.15 for the current fiscal year, representing a 9.3% increase over the prior year. All eyes are on Thursday, January 29th, when Apple reports its first quarter fiscal 2026 results. This is the holiday quarter, typically the company's strongest. Wall Street consensus forecasts revenue of nearly $138.4 billion, which would be a 10.4% increase year over year. Earnings per share are expected to come in at $2.65. Investors should watch for three specific things in this report. First, iPhone demand in China. With reports of a 26% surge in shipments there, confirmation of this recovery is critical for the bull case. Second, guidance on services and margins. CFO Kevin Parekh previously hinted that gross margins could land between 47 and 48%, assuming $1.4 billion in tariff impacts. Third, any commentary regarding the Apple Intelligence Roadmap or the rumored hardware developments like the foldable iPhone or AI Pen. If Apple beats these expectations, particularly on the revenue side, it could validate the buy-the-dip thesis. However, any weakness in the China numbers or soft guidance for the March quarter could exacerbate the current selling pressure. To wrap up, here are the key takeaways from this week. Apple stock has entered deeply oversold territory, down roughly 9% in the last month, catching the eye of value-hunting analysts. Rumors of a wearable AI Pen for 2027 and a foldable iPhone for late 2026 highlight the company's long-term hardware roadmap. India provided a bright spot with record shipments and market share in 2025. Institutional activity saw Peter Thiel moving capital into Apple, while NVIDIA officially surpassed Apple as TSMC's top customer. The immediate direction of the stock likely hinges on the January 29th earnings report, with high expectations for iPhone 17 performance and revenue growth. Thank you for listening to this week's edition of TickerWatch. As always, remember that this content is for educational purposes only and does not constitute financial advice. The markets move fast and risks are always present. If you found this update helpful, please consider subscribing and sharing this episode. Tune in next week as we break down the earnings numbers and see if Apple delivered on the holiday hype.